You're watching Smart Money with me, Alishia Seckam, and today we're catching up with Hannes van den Berg, head of SA Equity at 91. Hannes, thanks so much for joining us today. And it's a month post-elections locally, right? South Africa has a government of national unity in place, and while some dust still needs to settle, and while there is some trepidation about where things are headed, sentiment has been seemingly positive. Talk us through your outlook for SA Equities in that context.
Yeah, we're definitely toasting to a very interesting last 30 days. Lots of emotions, and one day you thought there was agreement, the next day disagreement. So it's been a very interesting, truly South African last 30 days. We've seen South African equity markets and bond markets with stocks and opportunities exposed to the South African economy, as you say, generate very strong returns over the last few days. So the emotion, the opportunity, and probably the way in which people are thinking about South Africa has definitely become more constructive after this government of national unity agreement has been reached.
Absolutely. But, and this is a big but, right? Because the focus shifts now to how much actually works to change South Africa's economic growth trajectory more to the upside. And as we wait to see, where are you finding growth opportunities in the local markets? Because so far, local equities have not re-rated in line with its global counterparts. We've got sectors like our banks, our retailers, still trading at discounts to their 15-year averages.
Yes, that's a very good point. I mean, we like to focus on companies or businesses with improving earnings profiles. We like stocks or businesses that deliver earnings growth from one year to the next. So when we look for investment opportunities, that's where we start. We like to buy those at a reasonable valuation. And what you've seen over the last month is no real change to growth and earnings expectations. You're absolutely right. So this is purely sentiment changing to the deep discount that we've been trading. I mean, South Africa 2023 went through a lot of uncertainty, slow growth, in addition to that political uncertainty, load shedding, and obviously port and rail issues. So the base for earnings and expectations from companies is quite low going into 2024, and we've seen a re-rating relative to that history, as you said over the last few years. We're trading at a discount, but the growth trajectory has not really changed. So how we're thinking about it is the sentiment has changed in the short term. Now we need to focus on the medium term, which is the next 4 to 6 months. And on that front, we look forward to interest rate cuts potentially coming. And that probably depends on what happens to the interest rate environment globally. We've got less load shedding, over 100 days of no load shedding. People thought it's because of the election, and now we're a month after the election and still we don't have load shedding. And by the way, we've gone through severe storms in Cape Town and a lot of cold temperatures across the country, and still the electricity grid is supplying. And then we've got the two-pot system, which is going to have a short-term, very interesting impact, we tend to think, on the South African consumer. Beyond the next 4 to 6 months, you asked the longer-term question. Lots of people writing around a 2% growth rate in South Africa. Can we achieve 2 years of above 2% GDP growth in the country? And that would lead to job creation. And that's probably what we need over the long term for South Africa.
Yeah. So while we wait in the interim, I mean, where are you seeing the opportunities relative to, what have been popular global opportunities up to this point?
Yeah, you're right. You mentioned the global opportunities. I mean, the S&P 500 and some of the global markets have delivered 10 to 15% returns for the year. The South African equity market is still at a mid-single digit, so 4-5% returns from the South African market. So from here on forward, we think there's opportunities in some of the SA consumer stocks. If you go into an interest rate cutting environment, that tends to help the wallet of the South African consumer. We've seen 2 and a bit months of fuel price cuts in South Africa coming through. The two-pot system, we tend to think for banks, the non-performing loan cycle, people having access to savings to repay their debt, together with the potential for a bit of extra savings that they can use for discretionary spending. In this macro environment of a stronger rand and lower interest rates, tends to bode well for some of the, let's say, clothing and discretionary and cyclical retailers. I've mentioned some of the banks, the likes of Capitec, potentially benefiting from the two-pot system, as well as the South African consumer, which is in their segment exposed to fuel and traveling quite a lot. And on the retail side, stocks such as Mr. Price, Truworths, Foschini screen quite well to us. In the insurance space as well, there are interesting opportunities. The NHI overhang was weighing on some of our our insurance companies and medical aid and the risks that would bring for the likes of Discovery has allowed us a very good entry point because they were trading at incredibly attractive valuations. And we tend to think that the earnings dynamics is underestimated by the market and will be more positive than expected.
Yeah. And it's important to highlight, right? Because if we do look at that global rally that we have seen, it's been pretty narrow. Case in point, NVIDIA driving more than a third of the gains on Wall Street's S&P 500. So how are you digesting the kind of market movement we're seeing globally? And if we can shift, focus now to the global arena, and what's it going to take for the market rally to broaden on that end, Hannes, as you see it?
Yeah, that's a very good point. And if I can build it up from South Africa towards the global, now that investors can have up to 45% in a portfolio on the global side, we look at what are the opportunities that present themselves in South Africa, and we've mentioned some of the SA consumer opportunities. We also like some of the resources opportunities. So then we don't have a lot of Rand Edge stocks. So when we look at the Rand Edge stocks in South Africa, we weigh them up against the global opportunities that we find, and we found better opportunities on the global side. So our SA portfolio starts with SA consumer and a bit of resources, and then we buy some of those, like you mentioned, tech, semiconductor, growth opportunities on the global side. We're also finding some good healthcare opportunities where we see steady eddy earnings growth profiles. And with these growth profiles, I mean 10 to 15% earnings growth, plus a little bit of dividend yield from year 1 to year 2 to year 3. So what we call the 3-year annual growth rate of the earnings profile of some of those global counters outweigh some of the opportunities we find in South Africa. So we quite like the semiconductor, the tech theme that's currently playing out. The broadening of the market is an opportunity for us. What we've seen is as the market starts to think about interest rate cuts coming for the US consumer and also in Europe, as that market broadens out towards other sectors and other geographies, we can actually add even more on the global side at the right time. And as the South African story plays out, it gives us an opportunity to deliver 20%, take profit, and then put that money onto some of those global ideas.
Yeah. Up to this point, I mean, we talk about the sentiment momentum driving global, local equity markets strongly. How soon before you see real fundamentals coming through to support? And I ask especially where we start talking about things like the reduced probability of a recession.
Yeah, so when the companies report, obviously now in South Africa in the next 2-3 months, we will still live with the history, the past 12 months, which has been tough. But markets are forward-looking machines. Markets reserve the right to form a view or an opinion of what's going to happen in the future in South Africa, as well as globally. We've seen an incredibly strong theme globally with regards to the chip and semiconductor and tech companies. People have sort of latched onto the resilient US consumer, which has outperformed Europe and China. As things stand at the moment, the market is starting to think that this can broaden now to other areas. So the probability of a recession, which was quite high last year after 5% of interest rate cuts, high inflation to get that under control, growth slowdown was needed. The market has definitely moved more towards a soft landing or a no landing potential scenario. People are talking about 3%, 2.8 to 3% GDP growth globally for the next year and going into 2025. That is trend growth. It's nothing shooting out the lights or reaching for the stars. It's also not a recession. So people are looking to where will the next layer of opportunities potentially be outside of this strong momentum tech trade that we've seen. And we're already starting to see in the last, let's say, week or 2-3, how that trend is broadening out to other areas such as Europe and also such as towards emerging markets.
Yeah. While we talk about those opportunities and what's to come on that side, we've still got to be very cognizant of the risks, right? And we are very aware of the fact that this is a big election here globally, and elections globally are creating a whole lot of volatility in the markets in the interim. So how are you managing the risk alongside the opportunities that you've highlighted amidst the uncertainty that's going to bring with it?
I've been doing this for just over 20 years, and what I've learned over the years, it's incredibly difficult to position your portfolio for certain political outcomes. We all didn't think Brexit was going to happen, and Brexit happened, and it had a certain impact on the market. We didn't think Trump would get elected. He got elected. We thought that would be bad, and equity markets rallied. So to play specific election outcomes and to position yourself is almost impossible. So what we try and do is we manage the risk in a portfolio which we can stress test it for certain currency commodity interest rate outcomes and see what the overall effect of that is. But we try and use elections and the volatility it provides as mispriced opportunities. You often find that volatility leads to certain ideas. We saw it with the French election and the volatility that's been going around with that over the last few weeks as well. Our French bonds and the French markets reacted to that, and then it stabilizes, and volatility actually provided an opportunity. So the US election is probably the big one that we all look forward to in November, and the risks or volatility that comes with that. But we try and navigate the portfolio to say, how will it react to a positive outcome and to a negative outcome in markets, and navigate through that. And while we go through that, make use of the mispriced opportunities that we find in each of those election volatility, periods of volatility.
Hannes, I asked the question, I guess, because one wonders whether investors should be tempering their return expectations.
Yeah, so what we often discuss around our desks is you have to distinguish between the headlines, which we read in the papers, which you see on your screens and on your phones when you open your eyes in the morning, and the trend lines. Markets do go through cycles. You have high interest rates to bring inflation under control, to slow down growth. The next phase will be, and in our view, it's not if interest rates are going to get cut, it's when and by how much, and that leads to growth, recovery, growth, and expansion phase. And there will again be euphoria, and interest rates will have to get high because of high inflation, but we look forward to that 4 to 6 years down the line. So as things stand at the moment, investors are worried. People are sitting on cash. Nobody's enjoying the growth slowdown, but we see this next phase of the cycle already starting to unfold. Some leading indicators, we look at manufacturing detail, inventory levels, etc., that we find across geographies and economies. We think the next phase of the cycle has already started, but central banks will cut interest rates potentially in the next 3 to 6 months. Some central banks, the ECB and the Bank of Canada, have already started to reduce interest rates. In SA, we look forward to interest rate cuts starting potentially this year. So the interest rate environment will potentially help us to deliver beta in markets. Having said that, deglobalization, demographics, decarbonization, all of that potentially leads to more sticky inflation and potentially slightly higher interest rates than we've had in the last decade. So we don't think it's 20-25% kind of returns, but we do look forward to 10 to 15% kind of returns that we can get from equity markets over the medium term.
Hannes, let's leave it there. Thanks so much for having joined us in conversation today. Hannes van den Berg is head of SA Equity at 91.